Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone. I have with us a special guest that we've had for probably last two shows and probably the next two shows, a specialist in life insurance, Ian George. I appreciate your coming back on the show. This is a show that I'm doing as a series. Ian George is a brokerage director with Mass Mutual Life. Now, the first in this series that we're recording, we're doing a four-part at least series for you to try to get through some of the areas in life insurance and how it fits into your life. The very first was a basic 101 discussion about the different forms of life insurance. The second show we did was a basic show on needs analysis, how to at least understand why people need life insurance when they do and if they do, and then to figure out just a basic amount of insurance that a person might need. What I wanted Ian to talk about today's show, there's a form of life insurance that is widely misunderstood. I'm not going to say it's so complicated, but it's widely misunderstood. And it came about on the area of term versus permanent and buy whole life versus term and invest the difference and all those transitions that happened over the last 30 and 35 years. And now coming full circle, how have they all worked? Well, the discussion I would like to have today is on the unique advantages and opportunities and differences with whole life insurance, which is still here after all these years of other products coming and going. So, Ian, I wanted you to try to share with us this issue of whole life insurance, how it fits in, what are some of the unique opportunities and advantages with it, and why people are still using it.
Okay, that would be great. One thing it's funny that you brought up the misconceptions and misunderstandings about whole life insurance. And, the one thing is that I notice a lot of people will say things along the lines of, oh, you shouldn't own whole life insurance. That's bad. There's surrender charges, there's this, and there's different aspects of these contracts that are bad. The one thing that's very interesting, and if you Google whole life insurance, some boy could take it on the chin. Well, obviously, in my profession, it's up to me to understand how all these things work, and it's also up to me to find out where people get confused and what's going on. And I will tell you that we have some people in our business who are out there saying things like, whole life insurance because of surrender charges and things along those lines, that don't know the difference between whole life insurance and universal life insurance that we discussed. Right. So what I would say is if you have somebody who is telling you that, and this goes with any product that you're ever looking at, I encourage clients when somebody brings up something, no matter what it is, if they say you don't want to do that, you want to do what I have to offer, ask them why what they don't want you to do, you shouldn't do, and make sure they understand what they're talking about. That's very, very important. Because I get a lot of people who have heard that they shouldn't do something, but then they don't know why. The advisor who told them not to do something didn't give them any foundation as to why they shouldn't do it, so there's no way that they should really know if it worked or not. But with that being said, a couple of things to remember about whole life insurance, and we did talk about this when we went over the chassis, and it is funny because whole life insurance is a very simple product. Not quite as simple as term life insurance, but it's pretty simple. So with whole life insurance, we have our mortality charge, or our cost of insurance, what it costs to carry the insurance that's fixed and level, and our death benefit and our premium. All those three areas are guaranteed. And then on top of that, we either have interest rates or dividends that are going to be pushed in on top of that to grow the cash value and or the death benefit. So what's interesting is that a lot of people have seen where whole life insurance can be used as a savings vehicle. It's a place where I can put some money that that provides me death benefit as well, that can grow and I can have money in there that I can have access to. The thing to understand about whole life insurance is that there are not surrender charges. Whatever is in there is available. It's one number. So as it accumulates and you want to have access to it, it is there and it's available. Depending upon how you take it is something that you need to work with your advisor on, but you can have it. It just depends on the best way to take it that suits your personal needs. Now, one of the things that goes on with whole life insurance are all the different features that come up with it. And so what we decided to do is kind of do an overview of what those features are and why they can be, great advantages to certain individuals if it's something they'd like to take advantage of. So I'm going to start with one of my favorite features because it ties into a little bit about what we talked about, which was disability insurance.
Right.
So one of the things about it is people will compare everything they're doing to save for retirement or to save for a legacy plan. We have a lot of individuals who, as they're putting money away, in the back of their mind, that money is not earmarked for themselves to spend in retirement, but it's something that they want their children or their grandchildren to have. And obviously, life insurance is a great way to do that. But one of the things that we take a look at is if something were to happen to us, if we were to become disabled, what would happen? So we do know that if I were to become disabled, that I would have problems with my paycheck. So I probably have my group group long-term disability would, pay me. I would also have, hopefully I've sat down with my advisor and taken care of my individual disability. So I've stabilized my family income. One of the things that has changed is that I may not be continually funding my retirement plans. And there are, by the way, just to keep an eye out, some disability policies that will help you continue to do that as well. But that's a different topic for a different time.
Right.
The one unique factor is the waiver of premium on a whole life insurance contract. And what that means is that you have an asset that you're funding for retirement or for legacy planning that, should you become disabled, becomes self-completing. That means that the insurance company is going to take all of that premium payment that you're making and pay it into your policy, continuing to grow your cash value and continuing to grow your death benefit even while you're disabled. And remember, even though they're pushing the money in, it's another safety place that an individual can go and actually take money from their cash value and help them if they need a little extra help in the event of their disability. So waiver of premium on a whole life insurance policy can be a very valuable benefit should somebody be facing disability.
Yeah, and especially what we've run into are a lot of cases, even with the group products, people who count on group life insurance, for instance, and I'll caution them based on history that a number of people who die prematurely might have developed either an illness or due to an accident. They might have become disabled first, run into medical difficulties, lost their job, lived for a couple years, struggling with their bills and their medical bills, etc., not able to even maybe keep their house, and then die prematurely. Well, what happened to their group life insurance through that? If they were disabled, they probably lost their group life benefit once they terminated employment. And if you have an individual policy and you were disabled, again, they're not paying, even on the best disability policies, typically more than around 60% of your income. So you're already making cutbacks. Can you then even afford to continue to make the life insurance payment that then if something happens to you, you were diagnosed with cancer, you lived 3 or 4 or 5 years and then died prematurely, your life insurance may no longer be there for you when you needed it most. Where with the rider that you're talking about, the premium waiver assures that your policy continues even when you can no longer afford to pay it if the cause is due to disability. It's a critical component that you're pointing out on a whole life policy that's available.
Yes, and it can be very, very valuable to families. The other areas, we're taking a look at what goes on with all of that. So you have now your whole life insurance contract and you have a waiver of premium that's going to actually complete an asset for you that's going to have cash readily available for you that you can have access to. That can be a very valuable benefit in the event that all that occurs. Other features that have started to occur with whole life insurance, or things that people are starting to notice of how they can use with whole life insurance, is let's talk about one special rider that's come out that's pretty new in the whole life insurance world. There are a number of different carriers that are offering this rider. Again, you want to work with your advisor to make sure you've picked the right carrier for you and that the policy is working the right way for you in terms of how these riders go. But there are riders that allow you to have access to the death benefit of your whole life policy in the event that you have a long-term care need. So basically what that means is, on the outset, if you were to buy a $100,000 policy, you would have $90,000 of that. In most cases, they're using a 90% factor with the different carriers of cash available for the use for long-term care. For most of these contracts, you do have to qualify for the long-term care, meaning you have to not be able to do 2 of 6 activities of daily living. Or it can be a cognitive standalone benefit, meaning the doctor has said it's not safe for you to be alone, and in that case the policy is available to be used for whatever the parameters of those policies are for you to use that for long-term care. So you can imagine, Jack, we just went over this with the waiver of premium. We now have an asset that we've been using that's growing this cash value, that we can access our cash value when we see fit in the most appropriate way for us. If we become disabled, that cash value and that policy is going to continue to grow because the insurance company is going to cover our premium. If down the road that disability turns into a long-term care need, we now have a policy that's going to have a death benefit where a lot of that, 90% in a lot of cases, can be used to cover that long-term care.
We've actually seen in the financial planning world, we've looked at how do we solve the problem for long-term care needs. We've looked at the long-term care insurance. There are pros and cons on that. We've looked at one of the alternatives as life insurance proceeds to replace assets lost due to a long stay in a nursing home. But it's after the fact. The life insurance proceeds did not come at the right time. So the spouse at home, let's say in an example, might have depleted their assets to pay for the stay for the other spouse, the institutionalized spouse, in the nursing home. But the life insurance could, upon the death of the institutionalized spouse, in some cases replenish or replace those assets that were lost. Well, now with the rider, it helps trigger the potential benefit being due and being able to be claimed at the time of need, rather than actually depleting the other assets for the nursing home stay and then upon death recouping those assets. With this rider, the benefits can possibly be there at the time of need to help defer or postpone or maybe eliminate entirely depleting the assets.
Exactly. So you have that protection tool. There's another feature that goes on, which is standard feature. It's not a rider. It's just included in all the whole life contracts that you're going to take a look at, and that's obviously the cash value and what that can do. But added on top of that is many carriers now offer the opportunity for limited pay contracts. Now, limited pay contracts offer the client the opportunity to pick an amount that they're going to use to pay, and it's going to be guaranteed that it'll be done paying in a certain year. The shortest of these usually is 10 years, although some can be shorter, but you can have a 10-pay contract that as you're pushing your premiums into that, at the end of 10 years, it's paid up and guaranteed to be done. This can extend in a whole different area of taking it out longer, for it could be a 20-pay or it can be, a birth year, or excuse me, not a birth year, but an attained age, such as paid up at age 65. Where these contracts have become purposeful for a lot of individuals is when they really are looking at the cash value as a savings vehicle for them, for what it can do. For somebody to be able to take money and put it into a 10-pay whole life insurance contract and have that bucket of money just sitting there with a death benefit on top of it and have those both continuing to grow and know that they can have access to them can be a very nice feature for them to have, knowing that they have a place where they can access that cash value. And if they access the cash value and take a look at their surroundings and what's going on then with their tax code and how they're touching the cash value, they very rarely will have to pay tax on accessing that cash value. Again, that's something you need to work with your advisor to make sure you're accessing it in the way that is best for you as an individual. So we have a couple of features there that are pretty strong in terms of what goes on, but again, it's where I spend a lot of my time, so I obviously believe in how these things work. So the waiver of premium is very strong. You have the long-term care access, which is also strong, and then you have the limited pay contracts, which also bring in other features to the whole life insurance as well.
And we've even taken that further to an extent where sometimes in financial planning, we'll look at the amount of assets in retirement, and I might have a spouse who says, I'm worried about how to handle and manage these assets because if anything happens to me, one spouse might say, the other spouse may not be as adequate at managing assets. So sometimes we'll carve out a percentage of those assets and do what's called a single premium. We'll carve it out, put it into a life insurance policy to leverage that percentage of assets that we've carved out to leverage the benefit. Can you explain a little bit about how that might work?
Well, with single premium policies, basically what you have is you're basically handing over to the insurance company one lump sum of cash. Depending upon the type of the contract, because you have single premium whole life contracts and you have single premium universal life contracts. Now, with a single premium contract, obviously we don't care too much about the waiver of premium.
Right.
That's a one-shot deal. So we've taken our money, we've put it directly into the whole life contract. In many cases, obviously, you may start with close to or a little less than what you actually put into it in your cash value. So you've transferred cash in. In any case, you're going to have a death benefit, which is going to be greater than your cash value, obviously. So if I put money in here, I'm going to have my cash value, and I'm going to have my death benefit. Over time, both of those are going to grow. My cash value is going to grow, and my death benefit is going to grow. Where these types of ideas become very valuable to people is when they're taking a look at what they're doing and want to think about what they want to leave for their family and how they can do that. Now, the one caution that people have to understand about a single premium is the policy, in terms of accessing the cash value, will have one bit of a tax wrinkle, and that is that you will have to pay taxes on any growth it attains. It's called a modified endowment contract, and I don't think we need to go into too grave a detail about that, but just know that any growth when you do a single premium on those policies will create a taxable event should you want to use the cash value. The death benefit, however, will remain tax-free, again, provided it falls under the estate tax rules and of where you are on the federal basis as well as the state in terms of under 5 million or 10 million with unified credit for your wife.
Okay, now that's an important concept because the person who has the need or desire to carve out a percentage of assets, put it into a contract as a single premium, may want to talk with tax advisors and the financial advisor and say, okay, this is my area that I want to carve out and my percentage, 30% of my assets or whatever. And by your advice, may be told that's your end result that you want to end up in the policy, but to not end up in a modified endowment contract, otherwise known as a MAC, you might be advised take 1/7 of that amount every year for 7 years, called the 7-pay test or whatever, to get in up to an amount every year before you cross that penalty threshold, and it may take you 6 or 7 years to fund that amount. Is that right?
Correct. So you can take a look at, you can sit down with your advisor and find out how you can fund that it may be to your advantage. To some people, they don't care. The cash value is no longer an issue. If I have this amount of money that I can automatically, upon my death, turn into this amount of money, and if the only thing any of this is for my heirs, that may not be something they're concerned about, and that's where the single premiums can really have their effect. By the way, just to make life more complicated in terms of where some of these features go, nowadays as well, we go back to the long-term care conversation, there are a number of those programs that provide even greater long-term care benefits with a single premium product, where you're depositing your premium into the contract, you're getting very large long-term care coverage for it, and actually life insurance that's a bit less than your long-term care, but still more than your cash value, but not a lot of cash value growth. Again, these are areas, these are other features and other ways that these life insurance contracts have grown. Those exist both for whole life insurance as well as universal life insurance. Again, just beware that you understand how those contracts work and who's offering them. In other words, is the company I'm buying this from a stock-held company? Is the company that I'm buying this from a mutual company? As you can guess, I'm a little biased towards mutual companies when it comes to cash value-based life insurance. Again, primarily it comes down to who's paying me, who's in front of me to get paid on dividends. In a mutual company, I'm part owner of that company. In a stock-held company, as a policyholder, I fall behind the stockholder, so I would like to be first in line. So I like, if I'm getting cash on a contract, I'd like it to be with a mutual company.
And the other issue is when Ian says become aware of the different forms of insurance and different benefits available, I again turn back to do not try to do this yourself. Get to a qualified professional who deals with this and has dealt with this for years and years. You might run into a situation and not even realize it, where you're making payments for a policy and it serves your needs and you have the premiums scheduled, but they run forever. You're paying the premiums forever by your policy design, where with a simple advanced preparation, you might realize, hey, when we're retired, we don't want to keep paying these premiums. What little twist do we need to make when we're first purchasing this policy to make sure that it is a limited pay time period that you have to pay, that by the time you're 65 or over 20 years or 10 years, the policy is fully funded and you don't have the premium burdens in retirement that you can't afford to make. So get to a qualified professional, help diagnose not only your needs, but diagnose your abilities to pay, diagnose which types of policies and features on those policies are best suited to you, and end up with a tailor-made portfolio of life insurance, just like in every other area of your life. Ian, I want to thank you for coming back again.
My pleasure.
We'll have you back for the next show. Hopefully there we'll try to wrap up our initial evaluation of life insurance for all of you coming. Thanks again for tuning in, and we'll be back again next week.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.